Okay, let's dive right into this explainer and perform a bit of a financial autopsy on Moody's record-breaking first quarter of 2026. If you follow the financial data sector at all, you already know Moody's is a complete titan. But what actually happens when a legacy moat like theirs perfectly intercepts the massive artificial intelligence boom, all while flexing some serious pricing power? Well, we get the numbers from this exact quarter. We're going to look under the hood today to see exactly how they orchestrated a quarter that's essentially reshaping their near-term financial trajectory. To make sure we grasp this complex report effectively, we're going to follow this clear five-step structure, starting with the record Q1 results, hitting the engines of growth, looking at operating leverage, shareholder returns, and then wrapping up with their 2030 AI outlook. All right, Section 1, record first quarter results. Let's start with the big bang that grabbed Wall Street's attention right out of the gate. $2.08 billion. Moody's posted a really impressive 8% year-over-year revenue jump to hit this mark. Honestly, in the context of the broader market, 8% top-line growth for a company of this immense size, that is no small feat. It just proves that despite all the macro volatility out there, demand for their core services continues to march steadily upward. But to really understand that revenue, we have to look at the volume behind it. For the very first time in a single quarter, rated debt issuance blew past the $2 trillion milestone. $2 trillion. That is a staggering amount of global capital flowing through the market, and all of it required Moody's stamp of approval in just a 3-month window. To put that into perspective, that's roughly equivalent to clearing the entire GDP of Canada in a single quarter. This isn't just a record for Moody's, it's a massive testament to the scale of global capital markets right now, with Moody's sitting right there at the toll booth. Now take a look at what CEO Rob Fauber had to say about this. Yes, he highlighted the record revenues and the $2 trillion in issuance, but notice the very end of his statement. He specifically calls out the acceleration of AI adoption as a primary demand driver. Keep that in your back pocket because we're going to circle back to this AI narrative. It is absolutely the hidden current driving these massive top-line numbers. Moving right along to Section 2, the engines of growth. Let's dissect the two major organs of the business here. So you've got the credit rating side, MIS, and the data and software side, MA. The crucial takeaway? They are both firing on all cylinders with identical 8% growth rates. MIS pulled in just over $1.15 billion, while MA brought in $926 million. Seeing both segments perfectly in sync like this is exactly the kind of balance you want to see as an investor. One isn't dragging the other down at all. But let's zoom in on Moody's Analytics for a second, because the quality of its revenue is what Wall Street truly loves. Annualized recurring revenue, or ARR. This is vital because Moody's Analytics isn't just selling a one-off product and hoping customers come back next year. A staggering 98% of their revenue is recurring, driving an ARR of over $3.6 billion. That is highly predictable, sticky, subscription-based cash flow. Section 3, operating leverage in action. Let's see how this top-line revenue builds into massive profitability. Behind this iconic logo is a business model that scales incredibly well. Operating leverage is basically a fancy term meaning that as your revenue goes up, your expenses stay tightly controlled. Because Moody's has such an entrenched brand moat and incredible pricing power, they don't have to continuously double their costs just to double their output. Every new dollar falls almost straight to the bottom line. When we compare these figures from Ticker against the broader financial data landscape, we see Moody's operating margin of 46% sitting comfortably above FactSet's 30%. Now, they do still trail MSCI's structural lead of 54%, but remember, MSCI operates a slightly different model that's heavily weighted toward indexing. For Moody's to post a 46% margin across a blended ratings and analytics business, that's just a phenomenal display of profitability. And this data clearly shows that the compounding leverage thesis isn't just industry hype, it is a measurable reality inside their specific income statement. Total margins recovered from a 37% trough in late 2024 to 46% today. But look at that MIS margin, a staggering 67%. That means for every dollar they make rating a bond, 67 cents is adjusted operating profit. Insane. And on the analytics side, expanding by 250 basis points to 32.5% shows that their software segment is getting much more efficient as it scales. Section 4, returning cash to shareholders. How does this immense cash generation actually nourish your portfolio? Well, as you can see illustrated here based on Koyfin data,
Moody's has steadily raised its dividend for 17 consecutive years. They aren't just paying it, they are aggressively growing it, boasting a 10.32% annualized growth rate over the last year alone. In a world where inflation constantly eats away at purchasing power, owning a company that compounds its payout at over 10% annually is incredibly powerful for a long-term holder.
But here's where it gets truly impressive. Even with those 17 years of continuous double-digit increases, their payout ratio sits comfortably at just 27.7%.
To put that in plain English, this low ratio means they're easily covering their $4.12 annual dividend. They're basically using only about a quarter of their earnings to reward shareholders with dividends. That means they are keeping a massive war chest of capital left over to reinvest in the business, acquire new tech, or, as we'll see next, aggressively buy back their own stock. And buybacks are exactly what they're prioritizing. In just the first 3 months of the year, they returned $1.7 billion to shareholders, with a massive $1.5 billion of that being pure share repurchases. Shrinking that share count makes every remaining share that much more valuable. Plus, their free cash flow was so strong, up 26% year over year, that management was confident enough to upgrade their full-year buyback forecast to approximately $2.5 billion.
Let's move to our final section, the 2030 AI outlook. Let's look to the future and see how AI is becoming the brain of their next decade of growth.
Moody's knows they don't need to build the next ChatGPT from scratch. Rather than competing with the tech giants, they have a brilliant three-pillar strategy. They are strategically partnering with heavyweights like Anthropic, Microsoft, AWS, and OpenAI to inject Moody's proprietary risk data directly into enterprise AI decisions. Listen, large language models are only as good as the data they are trained on. By serving as the connected intelligence context layer, Moody's ensures that when financial institutions use AI, they are paying for Moody's data to guarantee those models aren't hallucinating on critical multi-million-dollar risk decisions. And the demand for AI infrastructure is already paying off today, right now, in their traditional ratings business. The top hyperscalers, those massive cloud computing companies building the servers required for AI, drove huge, unexpected investment-grade bond issuance in Q1. In fact, their Q1 issuance exceeded their entire full-year 2025 levels. So Moody's is basically winning twice here. They are providing the data for the AI models of the future, and they're collecting fees right now to rate the debt that's funding the AI infrastructure build-out. When you factor in this structural AI demand and combine it with their widening operating margins, you get some very bullish financial projections. Ticker's valuation model projects Moody's stock reaching approximately $735 by December 2030. From current levels, that implies roughly a 57% total return, or about a 10% compound annual return over the next several years. The compounding math really starts to accelerate when you blend their historic pricing power with this massive new AI growth vector. Which brings us to the ultimate question. Considering their 57% projected upside, that incredible 17-year dividend growth streak backed by a perfectly safe 27% payout ratio, and their totally unique position profiting from the global AI build-out, you really have to ask yourself if this data-driven compounder deserves a closer look. Moody's isn't just rating the modern economy anymore. They are actively monetizing its data across every single layer. Thank you so much for joining me for this explainer. Keep learning, and I'll see you in the next one.